So yes, this will be recorded. So I'm gonna upload this to you tomorrow. I'm actually uploading another video on YouTube today. It's called How I Would Relearn ICT If I Could Start Over. So I'm uploading that video. All right, let's get into it. So whenever I'm looking, so I'm gonna start with the inversion setup, and even if you don't use it, it's okay because it's gonna apply to everywhere else. Okay. Now, here's what I do. So let's say, I see an inversion setup. Okay. I'm gonna have to go back. The annoying thing about today is I'm gonna have to go back to like Wednesday because Thursday and Friday price action work great. All right. So here is a good example. So here is one entry. Okay. You can see this in inversion. All right. And you can see that no matter whether you use the inversion or not, this is also 2022 model. So I'm going to start with the 2022 model. So the reason why you guys should know every model, but maybe not use every model, is for this reason right here. So whenever you're looking to get in a trade, whether it be the inversion model, 2022 model, whatever it may be, okay, you're going to notice something. You're going to see it line up with other stuff. So here, we take out these relative equal lows. Okay, do we displace under these lows? Yes or no? Do we displace under these lows? All right, how do you know? How do you know we didn't displace on these lows? What have I talked about in the past? It didn't close. I mean, that doesn't really matter. But we wick below, and then what's the like measurement tool you can use? Like, how can you measure it? Yep. So again, this bodies do the damage, wicks tell the story. But how can I measure this displacement? I think I did it last. I think I did it last class. Yes, exactly. So I kind of draw out the previous range. So the previous range from me low day to this internal high. See that? So I do it from this low to this high. This is the previous range. And then when we break that range, I see, okay, when we break that range, do we go at least 50% down? Do we hit the 50% of the previous range? No, we don't. So that's like, again, you can just tell by eyeing this, right? If you all eye this, you could very, very easily tell this is not good displacement, okay? And if it's not good displacement, that just makes me more interested in a long setup. But you can clearly tell, like, even with like this is how you actually measure it, okay? And I prefer, okay, I don't want us to go past 0.5 of the previous range, and here we don't. But again, there's gonna be close calls. I feel like this isn't a close call. I feel like this could just easily be eyed, and you could easily tell, okay, there's no displacement. This is obviously liquidity purge. So that's all I gotta understand for that. Now, you get the 2022 model right here, okay? So here's a market structure shift. It's very clear. Okay, and we get the market structure shift after what? After purging this low. And here's what I'll say. So you guys know how I like to trade. I like to trade to where, okay, I'll see the market structure shift, but I don't trust the retracement unless we get an inversion. And you can see in this setup right here, we come up, we go back down, retracing this river valley gap. Here's a 2022 model. Does everyone understand why this is a 2022 model? And it's a breaker as well. So it's a breaker model. It's a 2022 model. But here's the thing. Let's say you didn't use the 2022 model. Here's the reason you should be looking for other models. All right. Let's say you got in this. So here's where you're gonna see ICT. So ICT's put random stop loss in the past. This is gonna be like a good explanation of why some of the stop loss he's put. So let's say you long this 2022 model. Where would your stop go? Where does ICT teach the stop to go? Yeah, stop would go low a day. So you can long here, stop would go low a day. And then you maybe target up here. okay, which would be a 3.5R. All right, so when you look at this leg, the last swing low before this fair value gap was made was right here. Okay, so we don't have a swing low here. We don't have a swing low here. We don't have a swing low here. No swing low, and then we make a new low here. This is the last swing low. So what does that entail? Well, how could you do a different stop loss? Like, I know ICT says to put it below a low, but what would be a better stop loss here that should still work? That would be better risk reward. A close beneath this fair value gap. Okay. All right. So, and most of you are saying a close below this fair value gap. Now, well, that would be not bad. There's a better one. There's a better one here, and I think someone almost said it. What would be a better one than here? Look carefully. I don't think a lot of you guys are gonna get this. Not the bottom half of the fair value gap. Not under the breaker. If it's under the breaker, that's still too much. If we have good price action, what should be the stop loss here? None of you guys are getting it. Not the CE. Yes, exactly. Pin got it. The stop loss should be a close under the bigger IFVG we already broke. See this? And that's the importance of understanding other models, because let's say you're looking for the 2022 model and you see that price closed over this inversion fair value gap. So it's now 2022 model and inversion fair value gap. Well then, yeah, I know, Chris, but you never said a close, I don't think. Maybe you did. I didn't see it. I'm sorry. So see how these so you're seeing a regular inversion fair value gap, and you're seeing a regular inverse and a regular 2022 model here. Now, typically, what I do is, if there's no inversion here, where would the stop loss go? Probably beneath the breaker or probably beneath the low. I mean, this would be the safest one, obviously. So that's where the stop loss would go. Now, when you see these examples combined, you now see, okay, well, this is an inversion setup as well as a 2022 model. So we should see whatever stop loss is meant for whatever model, that should hold. So if it's a breaker setup, the stop loss for the breaker should hold. If it's a 2022 model, the stop loss for the low day should hold. And whichever one's higher, that's the one you're going to want to use, because it's going to lower your risk reward. So in this example, the first stop loss is low day off this 2022 model. And the second stop loss is if we get a close under this IFVG. So which one's the higher stop loss here, making a better risk reward? The IFVG one is. So in this case, I'd enter the 2022 model, and my stop loss would just be wherever the inversion stop loss is, because it's the same setup. It's just different entries, and it makes the risk reward that much better. So do you guys see what I'm trying to say? Okay. So now let's say there wasn't a 2022 model here. Let's say there's no market structure shift, we just went up. Well, then the stop loss would still be a close below this, but the entry would probably be up here. So the entry would be worse, but your stop would still be the same. Because it's a 2022 model here, you can lower your entry and make your stop small, because it combines with both. Now, the confirmation entry that I actually took off this was this one right here. Okay. So what I did is I saw the reaction from here. Right? I didn't take this 2022 model. I saw the reaction. And then what I did is I entered on this IFVG because of the reaction. So I was still able to enter and have a pretty tight stop. My stop was just to close back below this, because we already kind of reacted to this. So the highest stop possible here would be close back below this right here. Okay, but I think the key thing to know here is like if you ever see two models combined and they're both textbook, whatever model has the highest stop loss, use that, because obviously if there's both models, neither should hit the stop. It's not like we're gonna like if this is truly bullish, it's not like the wick is gonna come down, hit the 22 model entry, and then go back down to low a day and then go back up, right? That's not gonna happen, especially if there's two models, because it's another confluence. What's likely to happen is price is bound to hold both this inversion and this 2022 model because they're kind of combined together. And Tom, no, it wouldn't. I don't really. I mean, actually, yeah, it would. If we go to like might be an. I bet this might be an order block right here. Let me check. Yeah. So there also is a 5-minute order block here. So we also have a 5-minute order block. Let me see if it looks better in the. Okay, it looks better in the 3. Again, the only reason why is because this is a full body. If you go to the 5, it's kind of a hammer candle with a giant wick. Typically, I like the full body better. So you also got an order block here. So we got 3 PD arrays here in the same area. We have an inversion to the left right here. We have an order block right here. And we have a fair value gap right here. So if I were to take this order block only, the stop loss would be on probably close under or a wick under this. Typically, if we support an order block, you should not go under this close of the candle. So that's the first stop loss. Okay. The second stop loss would be for the 2022 model, which would be the low a day right here. And then based off the 1, the third stop loss would be a close back underneath this low right here. So it would be, if you had to guesstimate, it'd probably be around here if I were to. So we've stop loss 1, 2, or 3. We have all 3 models kind of working in the same area. You should use the highest stop loss. If there's ever really bad price action or it's not a kill zone, chances are one might hit and the other might not hit. But if it's the New York kill zone, it's between the hours of 9:30 to 11. This is a great strategy to use, and it's gonna make your stop loss a lot better. Like in this example, this was at 10:28. We know price action is pretty good at 10:28. It already looked good from before. So the highest stop loss possible for each of this hold. Okay. And Wind Rider, the stop loss for the inversion model is if a close back below a candle. So we close above the inversion right here, the stop loss is a close below. And I kind of guesstimate like a worst and best case scenario. I would say this is probably like a mid case scenario. So I'd calculate my risk for like right here about. But it would probably be somewhere in this vicinity where we close below and then you get out. 5% of the time we will get a giant candle down to here, but that doesn't happen too often. You just want to be careful. Sometimes you can place a hard stop. So like I'll have like a hard stop like right here just in case. Just in case we get news or something, like I'll put it way under a fair value gap or something that should ideally hold. And because this should ideally hold, I mean, we shouldn't get to this line anyway. If price action sucks, then yeah, maybe we will, but it's not going to be in one candle. And yes, this is also a change in state of delivery as well. So this is a market structure shift, and it was a change in state of delivery. And if you don't know what that is, make sure to watch T-Trade's video. It's in the gold nugget section. Okay, and the reason why is because we get a series of down close candles, takes out a low. You can see 1, 2, 3, 4, 5 candles, takes out a low, and then we displace back above those down candles that took out the low. So right here will also be the change in state of delivery. And it's just, again, you're going to want to watch T-Trade's video on the gold nuggets. So do you guys see how there's like kind of 3 different setups here, but in good price action, you should always use the highest to get the best trade. And the highest one will respect or should respect. If price action's bad, there's times where it might not. But if you want to get those good trades, well, then use the highest stop loss for whatever model has the highest stop loss, because you're going to take a trade and there's going to probably be a few different models that you're going to see. And if you understand all the models, well, you should understand where to put the stop for all the models. So whichever one's the highest, then do that. There might be times where there could be an order block sitting right here. Like, I'll try to find another example after this, but Dirty Dangles, boys, just go to ICT Gold Nuggets, and there's a video by T Trades. Yes, Tom. Robert, if I see like a lot of volume come in and there's still like a whole minute till a candle close, sometimes I'll just get out. I'll show you another example. Let me see if I can find another example here. It'll probably be Tuesday. There's a model where I haven't shared too much, but it's like an OB combined with an inversion. I have to make one up here. Okay. I'm gonna have to make it up here. So we have an inversion here. Okay, and you can see price closes below it. We come up, retrace, and we respect it. The body still respects it. We go down. Well, how can I put a hard stop here? Where would it be a good stop? Where would be a good spot to put a hard stop? What if we could just get a ton of volume in? Does anyone see it? Look a little to the left of this area. Don't worry about the equal highs. Yes, the OB. There's an OB sitting right here. So what you could do is maybe you see an OB that's right above an IFVG, or maybe you see a volume imbalance, and your hard stop would be if we went above those. So so if we know what no OB is, right, and I draw a fib here, we got mean threshold right here, we got the open, and we got the close. Now, because this OB is a little on the bigger side, all right, because it is a little on the bigger side, what you're going to want to do is your hard stop should probably be above mean threshold, because these big OBs, typically we won't go to mean threshold unless it's really bad price action. That's the only time we're ever going to see that. However, in good price action, I mean, we should typically not even hit this. Now, if this was a smaller OB, let's say the candle closed here. I'm just gonna, all right, the intermediate threshold will be down here, and you could just put your stop loss. A hard stop would be above here. So in this case, your stop loss would be a hard stop above the OB or a close above. Does that make sense? So no matter what the close is, if we go back above that OB before the candle closes, you just get out. You don't want to risk any more than that. And those are the other inversion setups I like, because it kind of has an OB combined with a fair value gap, to where even if that close is really above, I'll still have a hard stop sitting at the OB. And I know that's a little advanced, but and I know this isn't the easiest to tell, but again, imagine if this order block was smaller. Imagine if it closed right here. Okay, or yeah, imagine if it closed right here. And imagine if we were playing price, right? Let's say I get in this candle, and I see the top of an order block is sitting at this black line. So what I'll do is I'll calculate my risk for this top of the OB instead of trying to guess. And then that will be my stop loss, and I'll do this. Okay. So it just shows you, like, for the people who don't like to take the fair value gaps or the inversions with no stop, such as like this example right here. Look at this example. Let me just, how can I take this on my chart easily? Okay, I'm gonna have to like somehow group these or something. All right. All right, so let's say you're long from here. Is there any order block supporting a long in here that would make this a good stop loss? Does anyone see anything that would make it a better stop loss? Yeah, exactly. Not really. The stop loss would be, okay, if we close above here, your stop would be huge. There's not really an OB. There's not really anything you can put for a hard stop. And it'd be like this, and the risk reward would be horrible. So do you guys see how in this situation right here, there's no order block that was created here that has like a hard stop? If, let's say this was an order block. Let's say this was a red candle, even though it's not. Okay, let me just see if I can draw this out. Let's say this was a red candle. Okay, so we'll put this over. Now, what you could do here is you could enter on this OB combined with the IFEG, and then instead of having the stop below the close below, you have your stop close below the OB. So now does that make sense what I'm trying to say? I know it may already make sense to a lot of you, but for the people who didn't understand it, like, you see the difference in, okay, my stop with an OB could be lighter here. It could be like this. Instead of, if there was no OB, it would be literally, it would be like this. See that? So about the other thing, okay, about the other thing, I'm just trying to show you in this example, okay, if there was an OB right here, instead of having the close above the fair value gap, you could just have it as a hard stop right here, because if we're having good price action and price truly is bearish, well then both of them should ideally hold. Okay. No, this does not increase the chances of price stopping out, because if price is good, it shouldn't hit either stop. If price is good, we're not going to close over this fair value gap and then go hit the OB and then go down. If we close back over this fair value gap, we're probably going to go back to the high. There's rare times we don't do that, but most of the time, whenever you see like another PD array, like a volume imbalance and order block combined, okay, you typically don't see either. Okay, typically either will not break unless you're truly wrong. Again, yeah, red folder news gets more wonky, but like during normal days, this is just, it's a really good method to save your stop loss. And people will comment on my YouTube videos, don't use this model, the risk reward's horrible. Okay, you can make your risk reward better if you find another PD array inside of a higher time frame inversion. Okay, people don't understand that. They choose to ignore it, or they're just dumb. I don't really know, but they don't, like, again, they don't choose to even look for another PD array inside of inversion. Like, I don't know, just doesn't make any sense. So like right here, we never actually inverse this, okay? Actually, wait, let me see. I bet you there's a good example for here. This is Wednesday. All right, right here. Look right here. We have a 2-minute inversion, BPR. Okay. For this one, ideally, here's your entry, and here's your stop loss back above the close above that. And then your targets wherever. I'll just put it there. Now, even for this one, do you see how we have an OB sitting right here as well? I know it's not the highest probability OB, but it also, there's an OB right here as well. So it's kind of, it lines up with this, which lines up with this. We have another OB sitting here too. What you could do is, instead of having the stop above here, you could lower it a little bit to maybe just a stop above the OB. See that? See how this OB is combined inside the inversion? So there's just another great example of, you can get better risk reward if you see an OB inside of a fair value gap, or an OB inside of an inversion, and then you can lower the risk reward. Okay, and you should be trading during the kill zones. Okay, if you're not trading during the kill zones, it's probably not work as well, obviously, but hopefully you can see what I'm saying. Now, what if this OB wasn't here? What if this OB wasn't there? Yeah, then yeah, it'd have to be the IFEG close, which then would make the RR just 0.5 worse, which is not great. So if you can find an inversion with an OB as well and can move the stop loss up to an OB, that's going to be your best scenario. But You can see without the combination of an OB or combination of any other PD ray, the risk reward is going to be much worse. And the candle doesn't even have to close here. The candle could close all the way up here. So if you have an OB to kind of set that hard stop instead of having the manual stop, that would be better. I mean, I prefer the hard stops, but with IFEGs, you obviously can't do a hard stop in a lot of situations, which has really caused me to improve a lot. But if you can get the stop loss, do that, because that's going to be way better. And I feel like the hard stop would be like above this OB, which is planted inside this inverse fair value gap. And chances are, if we do go above that OB, we're probably going to break the inversion fair value gap as a whole. So that's why you can lower it there. Would I re-enter if I got stop hunted with a wick? Well, that's the sacrifice you're going to make. That's probably only going to be happening in bad price action. Most time, 90% of the time, if we create an OB inside of an inverse fair value gap, we're not just going to randomly stop hunt you and then do this. Like, that's not going to happen. But I can see it in bad price action, if you get that, then yeah, maybe I would re-enter if we get like another bearish fair value gap, like right here. Maybe I would re-enter. And then I just do like a whole new play and I do this. And this is going to confuse a lot of people, but I do this and I would put the stop loss to close back above the fair value gap if we held it the whole time. So let's say you do the hard stop above the OB and we do wake up and stop you out, and then we get another bearish fair value gap and violate it again. Well, then I'd re-enter, and then I'd still have my stop in the same spot. My stop would still be closed above this because technically we wouldn't have closed above it. Does that make sense? Okay. This is just a random take profit. Honestly, you should place it here because it's the next liquidity pool at this low. So. Um. I learned about standard deviations, and I'm kind of wondering if you would even draw one here. Because technically this wasn't the manipulation leg. Because we never hit that high. I gotta ask the T-Trades that question. Alright, so I think that's gonna be Rick, you say draw them from here to here? Oh, from here to here. I mean, that's what I thought, but yeah, I guess. Yeah. All right. I think that's gonna be it for now. Again, short class. Weekly bias. We're not in a really obvious spot. So whenever we're not in an obvious spot, I don't really go in with a weekly bias. If that makes sense. I mean, weekly bias. Actually, here's what I'm gonna say. I'm gonna say I think we're gonna hit here, but we're way in premium. I'm not gonna be if I do long this week, I'm not sizing up. Like, why would I size up when we're so close to liquidity? I mean, I'm still bullish on the weekly, but I definitely would prefer something like this, maybe something like that, or that would make more sense. If we just go up and the daily ends up closing above this OB, then I think we're just gonna skyrocket to here. But if we don't get our daily close above this black candle here, that means what? That means we will not get a change of state of delivery. That would make me think we're going to go take out this low right here and then bounce from here, then take out this high. So it's all going to depend on if we close above this or not Monday or Tuesday. I'm assuming we'll know. Again, just not in an obvious spot to know if we're going to go up or down from here. I still think overall up, but we could very easily get a retracement first, which I would prefer this. But if we close above this on Monday or Tuesday, we're just gonna go straight up with no retracement. So, yeah, you like breaker standard deviations? Is that what that means, Mikey? So you draw standard deviations based off of breaker. Okay, let me see if I can find one. Very interesting. Back to Wednesday. So trying to find an example. So like, okay, this is an example of a breaker right here. All right, so right here, you just draw it off the breaker leg right here. Here to here. Or do you draw it from the breaker leg? Because here's the manipulation leg. Here's the breaker. So it'll be from here to here. Ah, the whole breaker leg. See, that wouldn't make sense to me. So you just draw it off the whole breaker leg. Not the breaker itself, the whole leg. Okay. Where do you learn that? Okay. I've never seen that before. Personally, I'm not going to do that, but interesting. Yeah, that's cool. I mean, I'd probably just do it off the manipulation leg, but what do you mean backwards? This is how T-Trades drew them. Again, for me, for my standard deviations, this is the manipulation leg because we take out this low and we take out this high. So because we take out both the high and the low, this would be the manipulation leg. So I draw my standard deviation like this, and I actually used this on Monday. I actually sold some at this -1 because I figured the bias is bearish, and you can see soon after hitting the -1, we end up rejecting big time. This right here. All right, that is going to be it. Again, don't forget my weekly bias is all going to depend on. It's still bullish overall, but the question is whether we get a retracement or not. I think we'll know pretty quickly on Monday. If we start trending above this OB again and we end up closing, then Tuesday's going to be bullish. We'll probably hit here. We'll make high of week on Tuesday. But if we see a really big dump and then retracement, I'll probably short the retracement on Monday back to this low. So I know it's 50-50 right now, but live price action is going to tell us more. But I still think we're going to go to all-time highs here. Just the momentum's a lot. And whenever we break low resistance liquidity, where's the final high we have to break? Well, the final high we have to break is going to be the top of the LRLR. This is the top of the LRLR. And we've broken a lot of it so far, but we've not broken the full thing. So ATH is all-time highs. Yeah. All right, that's going to be it for now. Thank you guys for coming. Time to watch the Bills game. And yeah, peace. But wait, one more thing. A lot of people so if you guys trade ES versus NQ, if I'm making this prediction on NQ and you're an ES trader and you're like, oh, I don't know what's gonna happen on ES, probably something pretty similar. If I take a look at ES right now, it's not as clean, but I mean, we still have. It still looks the same. Like it still looks like the momentum's up to like this high, if that makes sense, or even this high. So if you're an ES trader and you're like, oh, well, he's going over on Q, I can't learn from this. It's the same thing on ES, just a little different. You guys see that? So make sure you understand that. So premium members, I will see you guys tomorrow. I think I'm closing the sale tonight. I'm closing the 35 a month tonight, and we're getting a lot of members, and I don't like that. I kind of want people to slow down joining, so I'll probably just make it 100 a month, and hopefully not a lot of people join anymore. But yeah, if you're not in at 35 and you want to pay 100, be my guest. But that's kind of tonight. Again, I'll be live probably for free, not this week, but probably the week after. So yeah, let me know if you guys have any questions. I'll see you guys later, and yeah, go Bills. And yes, 35 will stay 35 for all old members. That's correct. All right, peace.